Introduction to ethical issues in business operations. Every business, regardless of its size or industry, faces ethical challenges. These challenges can arise at any level, whether in the workplace, in dealings with customers, suppliers, or even in broader societal issues. Ethical issues often involve balancing competing interests and navigating complex situations that require thoughtful decision-making. This module covers the common ethical issues businesses encounter, explores real-life examples, and provides frameworks for handling them responsibly. Conflicts of interest. One definition of conflicts of interest. A conflict of interest occurs when an individual's personal interests interfere or appear to interfere with their professional obligations to act in the best interests of the company. Conflicts of interest can arise in many business contexts, such as personal relationships. An employee or executive may have relationships with clients or suppliers that could influence their decisions. Financial interests. An employee might have financial stakes in a competing business or service provider. Dual roles. An individual may have more than one role within the company that creates a potential for biased decision-making. 2. Managing conflicts of interest. To manage conflicts of interest, businesses can implement clear policies and procedures, such as disclosure. Employees and executives should disclose any potential conflicts of interest to their supervisors or ethics committees. Separation of duties. Assigning roles and responsibilities in a way that minimizes opportunities for conflicts of interest. Clear guidelines. Companies should establish strict codes of conduct that define what constitutes a conflict of interest and the necessary steps to avoid it. Insider trading and securities fraud. 1. Insider trading. Explained. Insider trading involves buying or selling securities based on non-public, material information about a company. It is considered unethical because it gives certain individuals an unfair advantage over others in the market. Examples of insider trading include executives using confidential financial reports to make stock trades, employees trading based on non-public knowledge about a pending acquisition or merger. 2 consequences of insider trading. Legal consequences. Insider trading is illegal in most countries and can lead to heavy fines, penalties, and even imprisonment. Reputation damage. Companies involved in insider trading face significant damage to their reputation, losing the trust of investors and the public. Loss of investor confidence. When investors believe that insider trading is happening, they may decide to pull their investments, resulting in stock price volatility. 3. Preventing insider trading. Education and training. Employees must be educated about what constitutes insider trading and the legal consequences involved. Trading windows. Companies may restrict the times during which insiders can trade their company's stock. Monitoring transactions. Regular monitoring of insider transactions can help detect and deter any illegal trading activity. Bribery, corruption, and fraud. Bribery and corruption. Bribery and corruption are illegal and unethical practices that involve offering, giving, receiving, or soliciting something of value to influence the actions of an individual or organization. This can occur within businesses, government entities, or between companies. Example, a company might offer a bribe to a government official to secure a contract or gain favorable treatment. Bribery undermines the principles of fairness and transparency and can lead to substantial legal penalties for individuals and organizations involved. 2. Fraud in business includes any intentional deception made for personal gain or to damage another individual or entity. This can take many forms, including financial fraud, e.g., misreporting financial statements, consumer fraud, and even employee theft. Example, an employee misreports financial figures to make a company's performance appear better than it actually is. 3. Combating bribery and fraud. Businesses can take several steps to prevent bribery, corruption, and fraud. Clear anti-bribery policies. Businesses should have robust policies that define what constitutes bribery and the consequences for engaging in it. Whistleblower protections. Creating a safe environment for employees to report unethical conduct without fear of retaliation. Independent audits. Regular auditing of financial records can help detect fraudulent activities. Internal controls. Implementing checks and balances to prevent employees from manipulating data or engaging in fraudulent practices. Fair labor practices and human rights. 1. Ethical labor practices. Fair labor practices are critical to ensuring that employees are treated with dignity and respect in the workplace. Ethical issues in labor practices can involve fair wages, ensuring that employees are paid a living wage that reflects their skills, experience, and industry standards, safe working conditions, providing a safe and healthy environment to avoid workplace accidents and illnesses. Non-discrimination, ensuring that employees are treated fairly, regardless of gender, race, age, religion, or other characteristics. 2. Human rights in business. Human rights concerns in business extend beyond the workplace and can affect companies' relationships with suppliers, customers, and communities. Businesses must ensure that their operations do not contribute to child labor or forced labor in the supply chain, human trafficking through unethical business practices, environmental destruction that violates community rights or the rights of future generations. 3. Promoting fair labor and human rights supplier codes of conduct. Companies should hold their suppliers to the same ethical standards they expect from their own employees. Diversity and inclusion programs, promoting a culture of inclusivity and fairness within the company and supply chains. Monitoring, regularly auditing supply chains and workplaces for compliance with labor laws and human rights standards. Marketing ethics and consumer protection. 1. Ethical marketing involves promoting products and services in a truthful, transparent, and socially responsible manner. Unethical marketing practices include false advertising, making exaggerated or misleading claims about a product, bait and switch tactics, advertising a product at an attractive price, only to try to sell a more expensive alternative. 2. Consumer protection. Consumers have the right to fair treatment, transparency, and safety. Ethical businesses provide clear, accurate information about their products and services, protect consumer data and privacy, ensure that their products do not harm consumers' health or safety. 3. Addressing marketing and consumer ethics. Regulatory compliance, adhering to advertising standards and consumer protection laws. Truth in advertising, ensuring all marketing communications are clear, honest, and substantiated. Consumer education, helping consumers make informed decisions by providing them with the information they need. Summary. In this module, we examined a range of common ethical issues businesses encounter in their operations, including conflicts of interest, insider trading, bribery and corruption, labor practices, human rights, and marketing ethics. Ethical decision-making requires businesses to balance competing interests while maintaining transparency, fairness, and responsibility. By adopting strong ethical policies and practices, companies can avoid legal risks, enhance their reputation, and foster long-term success.